what attracted you to actually starting this accelerator? What was the interest in that?
In most cases, I would say you don't just get money, you get support and a partnership. So that's the great thing.
Okay, these are the checklists that you need to take care of before you think about VC funding.
Besides a check, what is important? What are you trying to get out of it? What kind of connections and support do you need from an investor outside of their money?
It's so important for the founder to be aware of all these terms and what are the potential outcomes and to plan this ahead.
When you take outside money, you give something in return. In the case of venture capital, you give up obviously the portion of your company in the form of equity, but you also give up full control.
Thank you so much for being here today, Lucy. I appreciate you sharing your time with us.
My pleasure. Thank you for having me, Lucy Stepanyan.
So I wanted to start with just talking a little bit about your journey to the VC world and how you got to where you are today. Can you walk us through a little bit? Because I have not seen many women in that space so far, and I'm just happy that I'm talking to one right now.
Yeah, likewise. Happy to have this conversation. I got exposed to the world of venture capital through my business school and an internship. Prior to business school, I worked at PwC in professional services for a number of years and touched every industry you can think of, from oil and gas all the way to entertainment, with the exception of tech. And I really wanted to get exposure to the tech ecosystem, so decided to pursue a master's degree and chose to be in Silicon Valley and decided to go to Berkeley. And while I was there, I was fortunate to have an undergraduate degree in business and economics, so that foundational sort of theoretical knowledge was already there. And I decided, therefore, to get involved in any practical applications, consulting projects with startups. I ran a accelerator that we had on campus called Launch, that is based on the Lean Launchpad curriculum. And we worked with startups throughout the program to help them with their go-to-market, with their strategy, finding the product market fit. And while I was there, I established partnerships with venture capital funds to bring them on board to give funding at demo day. This was my very first sort of introduction to the VC world, and I ended up securing an internship with one of those funds, Javelin Venture Partners. They used to be at the time a Series A sector agnostic fund based in San Francisco, so they invested in pretty much everything you can think of that wasn't super capital intensive. And really enjoyed my experience there. I loved the partners of the fund. I loved their approach to investment, their approach to working with startups, and the operational guidance and support they provided, and sort of fell in love with the world of venture capital. And since then, I've been working with startups in various capacities, helping them with their go-to-market and also helping them prepare for their first round of fundraising. And that brought me on to Techstars, which is where I mentor startups in early stages that are going through the program and are starting to prepare for their first fundraising.
Did you always know you wanted to be in the VC space as you were doing your MBA? Was that something that you had in mind and that was you're going for that? And then if that is the case, why? Why did you choose VC space?
Absolutely not. I didn't even know what the word venture capital meant before I went to business. And through that launch accelerator that I ran, that's how I got exposed to the VC world. That's how I found out what that structure of funding was. So I had absolutely no prior knowledge. I just got extremely fortunate and lucky to be working my very first fund work at Javelin, to be with the partners that I was, to be at the fund that I was, and just have a good experience. It's not a common thing, and therefore I'm just very grateful for that opportunity, but I had no exposure before that.
I want to pivot to our main discussion, which is basically early stage funding for early stage startups. So we're talking about pre-seed funding even, or seed funding in some cases as well. So if we think about a startup founder who has no idea what the VC world is and how to find VC funding, what should every founder know about the VC space before thinking about applying for funding?
Yeah, I would say if this is your very first exposure, read the book Venture Deals by Brad Feld. He's the founder of Techstars, and this is by no means supposed to be an advertising for it, but it is truly a wonderful book. It's the ultimate guide, I would say, for the preparation for venture fundraising. It covers all of the essential components like cap tables, term sheets, how to read them, how to understand them, how to prepare for them, and taking it a step further, how to negotiate actually those terms in these term sheets, which is really important. Generally, I would say the most important thing to know is that there's, of course, nothing free in this world, right? And everything has trade-offs. So when you take outside money, you give something in return. In the case of venture capital, you give up obviously the portion of your company in the form of equity, but you also give up full control. So depending on how much you're raising from who, you may give board seats to investors. And therefore, I would say it's important to make sure that you actually like that VC. You like working with them because they'll be there throughout your journey on your board. They'll be asking you questions. Sometimes they'll be influencing the decisions through those voting rights that they get to be on your board. So the key part there is would just make sure that what you give and what you get is that balance and it is something that you're comfortable with. Ideally, and in most cases, I would say you don't just get money, you get support and a partnership. So that's the great thing. There's some technical things that, of course, you should keep in mind. Cap tables, of course, you got to keep them clean as possible. If your cap table is very long because you have previous owners, the terms are restrictive, this may hurt your fundraising. So before you go to a venture fund, review your cap table with your founders, your counsel, check for any convertible notes or any safes for any caps or discounts that convert to additional equity, pre-money, post-money valuation. Have an option pool for your employees and make sure it's not too small and not too large for early stages. The typical range is about 10 to 20%. Go through these considerations and questions on the option pool, like what employees are you going to hire with this new money that you just raised? And how much are you going to give these employees? How fast? What is the vesting schedule going to look like? Have an idea of the valuation of your company. In early stages, VCs, of course, value your company on a number of factors, like what traction you have, what is the market size, what's your team composition, what is the future potential, right? But there are things that you can do to prepare. You can research companies that are in the same verticals or the same stages as you, look at the past 6 to 18 months valuations, see how much they have raised, at what price, at what valuation. What else? Be prepared for dilution. This is a painful topic, right? But founders should be prepared for dilution. Balance it against the value that you're going to get with that capital and the strategic support from investors. And look at the two, I would say, important things in the term sheet that you should look at is the liquidation preferences and any protective provisions and covenants. And for those of you that are not familiar with these terms, is liquidation preferences are the terms that define the order in which your investors are going to get paid back in the event of a liquidation event, such as a sale, a merger, even closing the company down. And it's important to understand these preferences because they affect the amount of money an investor gets relative to the common shareholders, which are the founders and employees. Generally, investors, of course, want to recoup their investment, potentially some more if there's a multiple, before other shareholders get any profit. There are initial payback periods. There's liquidation preferences with the multipliers. Sometimes they could be things like stacking preferences. If there are multiple investors that have been involved throughout the funding rounds, they can have liquidation preferences that stack, meaning the earlier investors get their paid first, get their portion first, and then potentially leaving less for others. You can have participation rights. Participating preferences are less favorable to founders, so try to negotiate them if possible. And if not, at least have a cap on those participating preferences if it's not avoidable. And then look for any protective provisions or covenants. And this is the terms in the agreement that protect the investor's rights and limit the actions that you as a founder, an executive, can take without their approval. For example, sometimes the VC needs to approve when they're selling certain assets. Sometimes they might need to approve when you're taking on debt. So really just understand the provisions that are affecting the control over your business.
Wow. I am overwhelmed already. So if I were to seek VC funding, I don't know if this would be too much for me, I think. Is there anywhere we can find like a guide, apart from the book you mentioned, like, because I'm assuming it's not a small book, right? So is there a guide for founders if they want to, let's say, go and see, okay, these are the checklists that you need to take care of before you think about VC funding?
I wouldn't say there is a specific checklist, but there are definitely some terms, like I mentioned, the valuation, the term sheet. The term sheet generally is that non-binding agreement that outlines all of these terms that are being offered to you when you're negotiating with the VC, and that is going to hopefully turn into a full fundraising agreement. The book I'm mentioning actually goes through all of these. It's not a small book, but it's not an overwhelming book either. They do an incredible job of explaining all of these. But also, as you go through these conversations with venture funds, as you go through conversations with startups, with other founders, you will get the hang of it. It sounds overwhelming, but it's not that bad.
Okay, that's good to know, because I'm already giving up on seeking for VC funding whenever I take the leap and start my business. But yeah, it's definitely a lot for a founder to remember. But I think that as you were saying this, I was thinking it's so important for the founder to be aware of all these terms and what are the potential outcomes, and to plan this ahead before going into the search for VC fund. At that stage, like having the preparation stage is just super important, because when you do start raising, then it's going to be super overwhelming if you are not aware of all of these terms and things that can happen and take place. So thank you for that. This brings me to my next question, which is, what do you think, at what stage should a founder even think about seeking VC funding?
There is obviously a number of criteria and milestone examples I can bring up, but I generally want to note that that's a very subjective questions, right? Because now there are investors for every stage. There is Series A, just generally that comes from the first letter of alphabet, right? That used to be the first round of funding. But then we got seed, which, judging from the word, that's where the seeds are being planted, right? But now we have pre-seed, meaning that maybe you don't even have the seeds planted. You just have an idea. Maybe there's not enough validation, but you already need some money. Additionally, today we have angel syndicate groups that are kind of operating like funds that are also really following angel criteria, but somewhat of a hybrid mix between a fund and angels. So I say always raise when you need to, but don't raise too early, because you want to avoid dilution if you can, right? But at the same time, don't wait too long and hinder your growth opportunities. In today's climate, the scaling of go-to-market is really, really important, because what we have been seeing is a lot of companies popping up and copying ideas at a speed that was not the same a few years ago. So it's much easier to have competitors popping up. And the differentiation at that point might not necessarily even be your product, but it would be how fast you entered the market and took the share of the market, right? So scaling the go-to-market. And for that, you really do need funding, because you're going to need to hire salespeople. You're going to need to hire people that can do the partnerships and get you those customers. So if you need to, don't wait to sort of raise the funding. The deal terms, in terms of the milestones and the requirements to raise the startup funding, are constantly changing. And they also very much matter from sector to sector and from the type of the business that you're having. But generally, you should have some type of a revenue stream. You should have attracted some customers and have a plausible plan of how you're going to grow. Ultimately, VCs are looking for 10x ideally on their investment, but on average about a 5x at a minimum. So you need to provide evidence that your startup has it and what it takes to sort of generate that kind of revenue. They also want to understand if you have the good team, if you have the experienced people in the right places. Does your sales organization, operations, marketing team look right? Do you have the right board of directors, the right advisors that are going to help you sort of carry on that vision with the knowledge and expertise? Like I said, it very much depends on the sector you're building, and it is quite different if you're talking from, let's say, B2B SaaS to deep tech and hardware companies, right? If you're in deep tech, hardware science companies, and if you're raising a Series A, you might not even have revenue. That might not be your focus. It might be the other milestones like having a prototype, having patents, having pilot programs with certain customers. On the other hand, if you are in the B2B SaaS environment, you should have an annual recurring revenue anywhere from 1 to 3 million for a Series A stage. So I would say those metrics kind of vary, but generally pre-seed, you should have at least some customers that are validating what you have so far, which is generally an MVP. You might not have that much revenue, and if you do, at least show some type of growth. For seed companies, you should already have some product market fit. You should have some recurring revenue, ideally anywhere from 50 to 200 on a monthly basis, and you should showcase some growth anywhere from 15 to 30%. And then once you get to Series A, you already have the product market fit, you already have customers. The money that you need is to expand, and therefore you have around 2+ million in ARR. You're showing steady 20-25% monthly growth rate in that revenue, and you're looking for funding to expand.
Oh, that's very comprehensive. Thank you. And if I am, again, I'm raising a pre-seed round, for instance, and I'm thinking, should I go the angel route or VC route? Is there any way you can decide which route to take?
Well, generally, I would say any fundraising that you get into, right? Angel or VC, there's a number of questions you should ask yourself as the founder, which is, how long do I want to run this business? What does exit look like for this business? Is it going to be a sale? Can I get so big that I can go through an IPO? Why do I think if I am going to go to a fund for an investment, why do I think that I can do a 10x, a 20x return to the investor? And then look at, based on these questions of where you fit on the map, what you're building, what are some of the options? They can be angel, they can be venture capital, but they can also be even corporate venture capital funds, right? With angels, I would say it's really a spectrum of interaction types, and it really depends on who the angel is. Are they a passive angel or are they an active agent? Are they an aspiring VC? Because a lot of people actually use angel investments to build a track record and then become a venture capitalist. Maybe they're even already currently a venture capitalist, but they are also investing their own money on the side as an angel. The key thing to remember is with angels is that they're putting their own money, right? So they don't have to answer to external parties and limited partners like a venture capitalist would. But this is potentially both good and bad, because they may have a longer appetite and patience, or they might actually have the opposite because they're looking to liquidate quickly, get their cash. They might actually do so in the future fundraising rounds. Because they're putting their own money, they often get more hands-on. And generally, angels offer a little bit more flexibility, founder-friendly terms that are not as stringent as the venture capital term sheets, potentially quicker time around with less due diligence. But again, it really depends who you're dealing with. That might be good if you need the capital immediately to deploy. But sometimes a very hidden and really important value of angels is their expertise, their network, their mentorship. And because they can be more hands-on, this will provide a lot of value to your company. The downsides of angels, of course, that's limited capital, right? Angel investments can range anywhere from very small check size of like 5 to 10,000 to several $1,000s. It might not be enough for you to get meaningful traction unless you go to many angels, and then your cap table gets messy. So the advice there would be is to do it through maybe a syndicate, where you fundraise really from one central group, and that's kind of like one line item on your cap table. They manage the relationships and the back and forth. You don't have to provide the same materials to so many people, go through the due diligence with so many people. So the level of engagement of angels can really vary. On the VC side, you get, of course, more capital. You get millions of dollars, right? You get a lot more structured support. They can offer you more guidance. They can offer you recruitment assistance. They can get you access to networks, whether that is investors, customers, talent. And one of the more important things that you get outside of capital with VCs, especially in early stages, is the credibility. So you get that branding of the fund, right? They can bring a lot of reputational weight that can attract customers, it can attract other investors, it can attract talent. If you and I decide tomorrow to go work for a startup, we're probably going to be a lot more comfortable if that startup has funding from Sequoia or A16Z than from an angel group or a fund that we don't know, right? But like I mentioned, nothing is free. There's always trade-offs. So with VCs, you get equity dilution, you give up a significant portion of your company. There are some stringent terms, provisions. They can potentially limit your ability to make decisions autonomously. And there is always that pressure for very quick, rapid growth and exit, because at some point they have to return the capital to their LPs.
Mm-hmm. Again, a lot to learn there as well. And if, let's say I've made the decision, I am going for VC funding, but I have no idea like how to search for even what is an appropriate VC fund for me. Where can I find a VC fund that works for me and then apply for it? Where do I typically look if I have no idea?
It's a combination of many different places. So VC generally is a very relationship-based and referral-based ecosystem. The best strategy is always to get a warm introduction from somebody rather than, cold outreach. Although I do have to say that sometimes, especially in highly competitive funding cycles like the 2020s, the venture capital boom, right? Cold, thoughtful outreach also works, but generally it's best to get an introduction. And so who do you get that introduction with? You have to build a network, right? So I advise the founders that know at some point are going to start raising to start getting involved in the ecosystem, seek introductions and build relationships, which means that you have to attend conferences. We just wrapped up LA Tech Week, San Francisco Tech Week, New York Tech Week. So go to these events, go to these seminars, try to meet investors and other founders, other industry professionals that can sort of make these connections. It's of course, a lot of time commitment, right? When you're building a company, you want to be head down and not really focus on these dinners and networking events. But what I like to advise is to dedicate a few hours a week. It can be just one day, 3 hours or so, to actually go to these events, meet people, build these personal connections. Because what you'll notice is that after a while, it is a small space. It's a hyper connected space. A few quality relationships can actually lead you pretty far. That's the networking side. There are structured platforms and databases that have informations on investors as well. One of my favorites is the Signal NFX. It's a platform that helps founders sort of discover and search investors based on specific criteria. You can filter by the industry you're in, by the stage you're in, and find investors, by the geography you're in, and find investors that sort of match this criteria and start building a list that you can further research and go through. One overlooked area, I would say, is the partners that you currently work with might have platforms like that. For example, I know that JP Morgan Chase has a platform called Capital Connect. Connect, and it pretty much functions the same way, where it introduces entrepreneurs, VCs, and LPs to each other to find opportunities and sort of get deals done. So utilize the current partners you have. That could be your accounting firm, that could be your law firm, especially if they are in the venture space. They probably have really good connections that they can refer you to. And then, just like with anything else, do some homework and research, create a targeted investor list. You can look at what stages they invest in, what is their investment thesis, go a step further and look at whether they have already invested in certain competitors and therefore may not be interested in your company, and really start just putting together a database. It can start as simple as an Excel form or Google Sheets form, whatever, and then you can build a CRM afterwards with the name, the investor, where they're located, what's their typical check size, whether they lead or whether not, because that determines how much time you spend for them. The first and most important thing when you're fundraising is to find a lead investor. And then hopefully they can introduce you to other funds that can bring the rest of the capital that you need to sort of close the round.
What is a lead investor again?
Lead investor is the one that puts the most money, right? And in a Series A or a seed stage, they also take the most of the equity and they take a board seat. So they are leading this fundraising route.
Amazing. So let's say I have found the right VC, at least that I think this might be the person that I want to apply for funding for. But I don't know what kind of questions do I ask this fund? What kind of background information do I need to learn about this VC fund? I mean, you mentioned a few things already. Do you mind sharing if you were a founder and you met with a VC, what type of questions would you ask them to know if this is the right fund for you or not?
I love this question because it actually, many founders skip this step, and it's probably not so wise because you're entering into a working relationship, especially again with your lead investor, and you should know what you're getting yourself into, right? With everything we do in life, whether it's an interview for a job, we ask questions, we research the companies, we try to understand their culture, whether it's a good fit for us. So it's pretty similar. I have a few questions that I like the founders to ask if they're already at the pitching stage and they already have a relationship and they can go through it. But before that, I would say there's a lot of preparation that you can do to have the answers to these questions. So things like what stage do they invest in? What's the investment thesis? Whether they lead or if they don't lead, those are things that you can probably do as preparation. But when you're already at that stage where you've ideally passed the screening by the junior level and you've gotten to the partner meeting, so just to give you an idea, you get to a partner meeting, usually that's a weekly meeting that happens when you have passed that initial screening, and now you get to pitch in front of the partners, ideally in their office. Post-COVID days, a lot of that is happening over Zoom and virtually. And when you raise, you'll notice that this actually is happening almost simultaneously with a number of funds and investors at the same time. So sometimes you might even have what we call a soft commit. So somebody has signaled you that they want to invest in a term sheet, right? Before you get to that, ask yourself the two things that are important to you, which is number one, what values do you want to align with your investors? So this is the culture aspect, right? What's your communication style? What type of people do you like to work with? Are they the type A people? Are they not? This is just the cultural fit. The second is, besides a check, what is important? What are you trying to get out of it? What kind of connections and support do you need from an investor outside of their money? And so then when you're actually pitching it, everything's great. Hopefully you're killing it. You can ask them these three questions. The number one is if they can provide examples of how they have supported portfolio companies beyond capital. What is the key differentiation of that fund, their strengths and areas of support? And this kind of assesses their value add. It could be mentorship, it could be industry connections, it could be operational support. It could be talent, whatever it is. For certain investors, you'll notice that they have a strong network of connections in the space you're operating, which means go to market, partnerships, customers. For another investor, you might have a talent partner that is actually part of the fund, and they will work with you to attract the best talent for you. Of course, if you're going through good investors, you'll have combinations of these in different areas, and so ideally you get more than one. But then how do you actually assess whether that's true or not? You check for references. The same way the VC is doing due diligence, we talk to customers, we ask them questions, right? We talk to other investors that have worked with you before. You should do the same thing with the founders they have invested in. So try to get a few connections to them. Ask for introductions. A good VC fund will always feel good about providing you those references, and then just have a conversation. See whether what the fund is saying is actually true. The second question is feedback. I am huge on feedback. I think people should always ask for feedback, especially in the fundraising pitch kind of situation. You should ask for pitch feedback, and you should do it right there and then, as early as possible. Don't wait until you have received the note. Don't wait until they have weeks have passed after the meeting. And it's not because they don't want to provide the feedback. It's just obviously you're 1 out of 10 pitches that they hear that day, and things kind of get lost, forgotten, notes, and et cetera, right? And let's say you got a no. We get no's in life and work in many ways, right? And there's a few ways you can sort of handle them. The number one, which is probably the worst, I would say, is get emotional, get upset, and try to push back. Obviously, don't do that in fundraising, no matter whether you agree with the decision or whether you disagree. If you do disagree and there is something that you want to showcase, I would say get on their email list and try to email them updates for your companies. Investors always appreciate them, even if they say a no, but they hear back from you later with updates on your progress. If it's a good thing, they'll come back to the table. The second way you can handle is sort of silently accept it, graciously accept it, move on. And that's, of course, better than the first, but not as good as the third, which is accept a no, but ask for feedback and be specific on what is it that led to a no, or maybe it's not a no, maybe it's just not a yes yet, or an immediate sort of enthusiastic yes, right? And if they say things like, let's say you're too early for us, or you're not fitting our investment thesis, then that means that you just didn't do a good job of a preparation and research on your end, and you need to do better next time. If it is something like it's too early, ask them, what metrics do you need to hit to be considered by them? For example, it might be you hit X number of customers, X number of revenue. You might need to showcase an X percentage of monthly growth rate. You might need to land a marquee client or customer, whatever it is. The good thing that you can do here is actually utilize that no for introductions. More often than not, you'll see that there are VC funds that will tell you no, but they will actually help you get to these connections. So if they're not the right type of investor, they might introduce you to somebody. If they want certain customer on your roster, they might have that connection and actually introduce you. And we love that. It's a relationship that you should build. Most venture capitalists actually want to support a startup in some way, even if they're not able to invest. They're pretty fairly open with their networks. So I would just say be open to the responses. Founders are generally very passionate about their companies, rightfully so. But it is important to keep in mind that while you are building your company, you're sort of looking inwards. You might have information asymmetry, you might have a competitive advantage, but the VC fund, they're looking on an external macro environment, right? So they might have deep knowledge about what's going on in the market. What's the fundraising climate? Or there may be changes in the behavior in your niche that you might not be aware, and they see that from the various different pitches in your sector. And I would say the third question is, where in the fund life cycle are they? Whether they invest afterwards, whether they have a follow-on investment strategy, what percentage of the time do they do follow-ons? It kind of helps you gauge their capacity and align with your startup's growth trajectory, because when you're going through the rounds of fundraising, if we see that an investor had invested in you early on and is following on, that's always a good sign. Follow-on investments always vary by VCs, their strategies. Some funds reserve a certain amount in their current fund so that they can support you through the growth. Others might actually assess you completely brand new investment, even though they've already invested in you from the previous fund, for example. So you have to just know what the different structures are, because then that's different incentives that they're following and different metrics that they're assessing.
Mm-hmm. Amazing. So we have 3 questions. Do you mind summarizing like the 1, 2, 3 questions so that we can keep them in mind again?
Yeah, sure. So the first one was the examples of support that they get from the venture capital funds outside of the capital, and references. So examples of portfolio companies that have actually gone through this. The second is pitch deck feedback, and what kind of changes do you need to make in order to get a yes, if that was not an immediate yes. Even if it is a yes, that feedback is still going to be helpful when you're going through the rest of the investors, because generally you need a number of them, right, to close the round. And then the third is a bit more technical, which is, where in the fund life cycle are they? Do they do follow-on investments? What percentage of the time do they do? Are they planning to raise another fund? When? What's kind of their cycle?
Mm-hmm. Amazing. Great. So I'm assuming you have mentored quite many startups and you have helped them go through different rounds and of raising funds. What were some of the biggest mistakes that you've seen among the founders that you have mentored that they made as they were raising funds from VCs?
Mistakes. I would say with everything that we pitch and apply for, right? Because this is essentially an application for funding. Whether you're applying for a job, whether you're applying for a university, dating profile, fundraising, it doesn't matter. Generally, we actually try to put the best foot forward. We try to present ourselves in the best light, right? And sometimes that means we exaggerate certain facts, and this can backfire, because the venture world is small and it is very, like I said, it's hyper connected. We know each other because we work with different funds and on different investors. So 2 things you shouldn't do is, you shouldn't play investors off one another, meaning say, oh, I have a commitment from this fund, because we're going to check and we're going to find that that might not necessarily be true, or maybe that's a soft commitment, not an actual check. And also, we're going to do due diligence, right? We're going to talk to customers. So don't exaggerate traction that you cannot back up. You might have a customer that you're testing something with, and you might say, you know what, we're going to have this revenue by the end of the year. But if you don't have a contract, or at least some type of a communication and signal from that customer, we will find out. So I'd say treat your pitches and your fundraising generally as a relationship building exercise, not a transaction, especially with the lead investor, because they're going to be, again, with you throughout the whole journey. Some other no-nos is don't ask for NDAs generally. Accept a no's gracefully, right? And try to use those no's again as opportunities for improvement, for other connections, for sort of turning into future yeses. Generally, if a founder is really prepared and has that solid components of what makes a good pitch deck and does a good job of articulating those things, they'll be good in the pitch.
Nice. And why not ask for NDAs? I think I know the answer to that, but it's just interesting from your perspective. Why shouldn't the founder, maybe he has an idea that's innovative, or at least he thinks that is, and he really wants to protect his innovation? Why does a VC think that it's not a good idea?
Yeah, VC funds generally look at this as the ideas are great, and you can have an incredible idea, but it is at the end of the day about the right execution that matters. So it's not, the funds aren't ever really investing in the idea. They're investing in a combination of things. And as history has shown in every innovation, you can have the same ideas in completely different parts of the world. And this has been happening, historically, even pre-internet, pre-phones. So in the days that we used ships to go from one place to another, we still had those scenarios where you had the same idea in different parts of the world. And so that's less of an important factor. It is the combination of the right team, the right execution, the hustle, the grind, the grit. So it's never about the idea, but also just going back to that fact that it has become so easy today to actually copy something that the ideas generally aren't going to work well, and it's not even the product that is going to work very well. You might have an incredible product, but if you fail at scaling your go-to-market very quickly, having that unique, quick, and sticky distribution to capture the share of market, whether it's through partnerships, whether it's on your own network, you will have a competitor that pops up in just a few months, whereas a few years ago it would take years for that to happen. And so therefore that's just so much more important of what are you doing from the company operations perspective.
I want to turn to pitching, which I think is one of the most important things, right? As you're considering to fund or not to fund. What are some of the things that you would say are just most important things for early stage founder to consider as they are pitching to a VC?
Well, I think, in my opinion, two things really make a pitch successful, and what really sets apart is solid preparation with hitting some of the key components that you need to in that slide deck. It's generally about 10 to 15 slides. They have to cover some of the key components, which is what is the problem that you're solving? What is your solution? How are you actually solving this problem? Why are you best positioned to actually solve this problem? So what is your key differentiation, your value proposition, whether that is industry knowledge, whether that is proprietary IP, whether that is certain relationships that you have. Who else is playing in the sand with you? What's your competition? How far are they along? And what are you going to do to beat that competition? Who's building this with you? So who's your team? What kind of knowledge and expertise do they have? And how are they going to be best positioned to actually tackle this? What have you achieved so far to make you think that you can actually tackle this? So get that traction. Where in that roadmap of your company are you, and why do you need money? How much do you need, and what do you need it for? Are you going to spend it on hiring? Are you going to spend it on product development, etc.? So these are the key components and data points you should hit in your pitch. And the second important aspect, from my view, is the storytelling. You might have all the right components and nail them, but it is the way you tell the story, the way that you engage your audience, right? Again, why are you best positioned to solve this problem? Maybe you have years of experience. Maybe this is a personal experience to you. So be authentic with that and tell a good story, and I think you'll be good.
Nice. I love that. What was the absolute worst pitch you have ever heard? Was there a case that you could say, okay, I remember this pitch, it was the worst, and this is why?
Oh, no, I don't like to think of them that way because I have utmost respect for entrepreneurs. There have been certainly cases of pitches that I've heard that weren't ideal. primarily they have come from very passionate technical founders that just don't have that skill set of storytelling, don't have that skill set of putting together a business plan and thinking from the perspective of the investor or a business, right? They are just passionate about what they're building. They're technical, they're engineers. So there have been lots of examples like that, but I wouldn't necessarily highlight anything that they have done wrong. I would just say that they definitely had a gap in their team of the right people to bring out those components that are important from an investment perspective.
You're too nice. Was there any pitch that really stood out for you that was like, okay, this one made it? Like and it really was engraved in your memory, and you just like, you always think about, if you think about the best pitch, that was it. Like, was there any case like that?
Yeah, there's a number of them, and all of them, right? As you asked the previous question of what makes a pitch successful, I actually thought about these examples. There's three primarily, and all three of them had those exact things, which is the solid preparation. They were on their A game, so it was a 3-minute pitch that they had to do during a competition. They had it timed, so it showed that they had practiced in front of the mirror many times. There weren't many ums and ahs and pauses, right? They had their slight changes and shifts from one area of the business to the other, very smooth transitions. So that solid preparation, they actually knew exactly what they need to hit in terms of the information that they disclose with their numbers, their traction. They had depth of information for post-pitch questions. So when a pitch happens, right, we respect your time, we listen to you, and then at the end, we of course have questions. And being ready for those questions with that additional information, that depth, whether that is a financial model, whether that's a data room with certain things that we're going to ask for after the pitch. So having that preparation is key, and the right storytelling. So engaging your audience, talking to them as humans, because at the end of the day, yes, they're investors, but they're human. So it's not rocket science. It's just about building a connection, and so storytelling is the second one.
Amazing, thank you. I'm going to wrap up with the last question, which is, in this rapid development of AI, in this world of, the change happens so fast we can't even keep up with it. What are some of the major trends and shifts in the VC world that founders need to be aware of, just to think about their strategy, their funding strategy in the future, and how they would plan it? Are there any major changes in the past year or 2 years that you've noticed, or things are more or less the same?
No, well, definitely, we're sort of out of that venture capital boom cycle outside of AI, right? AI is an animal of its own. It's been an extraordinary year for AI startups, and it's not just the amount of money that they're raising, which is in billions of dollars and throughout the year, but it's also the valuations, incredibly high valuations that they're getting. And these aren't just the outliers, right? This isn't just Elon Musk's AI company that's $24 billion. It's companies across sectors, across categories. And what I mean by that is you have hardware companies that are valued in billions, like Grok. You have research companies that, interestingly, at the moment don't have even a business model or an application yet. But they have founders that have come from certain places, like the Safe Superintelligence, which is started by Ilya from OpenAI. It's already worth over $5 billion. These are somewhat outliers, but we see these high valuations throughout the AI companies. In terms of the next few years, whether that is sustainable in terms of these high investment level, it is quite questionable. We're still in this, I would say, hype cycle, in this land grab moment. You have a lot of investors that aren't necessarily thinking fundamentally sound and are willing to pay the price to get in. I think there isn't a bit of an overestimation of AI's impact in the short term. Just number wise, right? I'm not questioning the technology. Of course, it is absolutely groundbreaking and innovative, and we're going to see it impact every single sector, but in terms of just the numbers. So in terms of the impact on founders, I would say founders that are building outside of AI has driven the competition down in other categories, and just keep in mind that there's still capital that is sort of earmarked for non-AI startups. There are funds that raised money according to theses that were not AI related, and that capital is still there, and you potentially have less competition because everyone is building in AI. So you have capital and you have less competition potentially. It's also true for the VC funds that are raising from LPs to focus on non-AI theses, and there's a number of sectors that we've seen with a lot of interest and a lot of growth, and that's primarily space tech, defense tech, green tech. On the other hand, if you are building in AI, there's of course that influx of capital that's created intense competition. And if we don't talk about these outliers that I just mentioned, right? For the rest of the normal companies, it's really important to have that unique value proposition that can't be easily replicated by the large companies that are building in this space. And one of the examples of that is this what we call AI wrappers. These are the applications that add minimal functionality. They are built on top of existing models. They sort of just provide the user interface over the existing models. And I don't necessarily see the value of them over ChatGPT or any others. So make sure that there is enough differentiation. There is a focus on addressing specific pain point, an underserved market potentially. So create a defensible position and consider if with the next rollout of ChatGPT's new version, right, or another large one, LLM, is your product going to be still differentiated enough and in use or not? Develop proprietary models if you can, and algorithms. Maybe the data that you're training on is proprietary. So just have that differentiation. And then the market domination, we've talked about it, how easy it is to copy. The speed of copying is really, really high with AI today. Yeah. The time that it took one company to come up with a similar sort of solution has gone down from years to months, which means that you should be shipping much faster than you used to before. And it is pretty intense. It's pretty crazy, but you scale your go-to-market and get it on the hands of customers. Try to have as much stickiness and distribution and as you possibly can early on. And for that, you need the right people, the right partners, I would say. Sometimes you're going to have an incredible product, but to get to the customers, you might need partnership networks. Can be channel partnerships, it can be product partnerships, whichever route is appropriate for you. And then the last one, I guess I would say, is the talent acquisition. The AI sector is growing very rapidly, right? But there is that demand for skilled AI professionals, AI engineers, machine learning specialists. So there's that fight for good talent, and the founders need to develop a really compelling vision of why these people should come and work for them. And if you have the right investors, hopefully they can help you with that.
That's amazing. Thank you so much, Lucy. This was very comprehensive. I'm sure it will be very helpful for startup founders who are thinking about getting VC funds and are raising now or in the midst of raising or just thinking about it. I certainly learned a lot, so I appreciate your time and your knowledge. It was like a whole, whatever you studied within 1 hour. It was very intense, and I love it. We'll unpack everything into the description. We'll share the links, the terminology and everything, and we'll make sure that it's also accessible for people to read as well. So thank you for that.
Wonderful. Thank you for having me. It was a pleasure, and don't be so overwhelmed. It's not that bad.
Yeah, if you say so.